Before we dive in, hit subscribe so you don't miss new episodes. If you find value, a quick tap, helps us reach more people. Let's get started.
Okay, let's think about those really core investments many people have. You know, the blue chip shares your big FTSE 100 names, maybe S&P 500 stocks.
Cornerstones, yeah.
Exactly. They're often the bedrock of long-term wealth, providing growth, dividends. But sometimes you need capital, right? And you really don't want to sell those long-term holdings.
That's a very common dilemma. Selling feels, counterproductive. It can trigger taxes, mess up your whole investment strategy you've carefully built.
Absolutely. So today our mission is to unpack a really smart alternative for getting liquidity in, say, 2025 without having to sell those prized blue chips. We're doing a deep dive into blue chip shares-backed lending.
A very relevant topic.
And we're lucky to have an expert with us today to help break it all down.
Happy to be here. It's definitely a strategy worth understanding, especially in the current environment. Great. So let's start with that core problem, the liquidity dilemma. Why is selling these blue chip stocks often such a, unattractive option for someone investing for the long haul?
Well, there are a few layers to it. First off, taxes. Capital gains tax, CGT, can take a real bite out of your proceeds when you sell.
Right. Nobody enjoys paying more tax than they have to.
Exactly. And with lending against the shares, you defer that. The capital keeps compounding. That's huge compared to selling. Second, it disrupts your strategy. These aren't just any stocks. They're often chosen for specific reasons within a broader plan.
Like the foundation of the portfolio, maybe.
Precisely. Selling them can throw the whole allocation off kilter. And third, you obviously lose out on what those shares could deliver in the future dividends, more growth.
Yeah, especially with these big, stable companies. We're talking about firms with huge market caps, long track records. They're seen as steady growers, right?
Generally, yes. They're the engine room for a lot of long-term, steady investment returns. So selling them feels like cutting off future potential.
Okay, that makes perfect sense. Selling is painful. So let's shift to the alternative. Blue chip shares-backed lending. Can you define that for us? What is it exactly?
Sure. It's basically a specialized type of secured loan. It falls under the umbrella of securities-based lending, or SBL.
SBL, okay.
The key thing is it lets investors use their eligible blue chip shares as collateral to borrow cash. Crucially, you don't sell the shares.
Ah, so you keep hold of them.
You keep ownership, you keep the voting rights, and critically, you still benefit from any dividends and any future increase in the share price.
That's the fundamental difference then, leveraging value without actually selling. Who arranges these kinds of deals? Is it your average high street bank?
Not typically. It's usually more specialized players. Think private banks, specialist lenders, or maybe the structured finance teams within larger institutions. They have the know-how to assess the shares and structure the loan properly.
Got it. Specialist territory. So let's get into the nuts and bolts. How does it actually work? What are the mechanics?
Okay, a really key concept is the loan-to-value ratio, the LTV. This basically sets how much you can borrow against the value of the shares you pledge.
And what determines that LTV?
It heavily depends on the quality and, very importantly, the liquidity of the shares. Are they easy to trade? Stocks in big indices like the FTSE 100 or the Dow Jones, very liquid ones, they usually get better LTVs, higher ratios.
Because the lender feels safer, knowing they can sell them easily if needed.
Exactly, lower risk for them. Now, regarding the shares themselves, while they're pledged, they sit in a specific custody account.
So they're held securely somewhere.
Yes, but, and this is important, you, the investor, retain beneficial ownership. You still get the dividends paid out. You still benefit if the share price goes up.
You keep the economic benefits.
Okay. What about the flip side? What are the risks? You mentioned LTV. What if the share value drops?
That's a really critical point. We need to talk about recourse. Most of these loans are recourse loans.
Meaning, if the value of your shares falls below a certain level, you're still responsible for repaying the full loan amount. The lender can potentially look beyond the shares to your other assets. Non-recourse loans, where your liability is limited only to the pledged shares, are less common but do exist.
Okay, so understanding recourse is vital. And margin calls. Is that a risk?
Yes, definitely. If the value of the pledged shares drops significantly, the lender might issue a margin call. This means you'd likely need to either pledge more collateral, more shares, maybe cash, or pay down part of the loan to get the LTV back in line with the agreement.
So you need a plan for that possibility.
Absolutely essential. You need to be prepared for market volatility.
Right. And what about the loan itself, interest rates, terms?
Interest rates are often quite competitive, sometimes fixed, which helps with planning. They're usually benchmarked against standard market rates like SONIA or SOFR. Terms can often be flexible, tailored to what the borrower needs.
So potentially competitive rates, flexible terms.
hmm
But it's not for speculating, you're saying.
Definitely not. This is about strategically unlocking value you already have in relatively stable blue chip assets for a specific purpose, like another investment or bridging finance, not for taking a punt.
Understood. It sounds like it has some significant upsides. Why is it becoming more popular? What are the big advantages drawing investors in?
Several key things. First, as we've said, you keep your market exposure. Your shares are still yours, still working for you, potentially growing.
You don't miss out on market upside.
Exactly. Second, tax efficiency is a massive driver. Pledging isn't selling, so there's no immediate capital gains tax event. Your wealth can keep compounding without that tax drag. That's a huge advantage over selling to fund something else.
That tax deferral sounds like a game changer for many. What else?
Well, you keep receiving all the dividend income from those pledged shares. That income stream isn't interrupted.
Okay, so dividends keep flowing.
Nice. Plus, accessing the cash can be much quicker than, say, arranging a loan against property or going through a complex fundraising process. Speed can be critical sometimes.
Faster liquidity. And I imagine for some clients, privacy matters.
Very much so. Especially for high net worth individuals, these deals can be structured very discreetly, tailored specifically to their needs. That privacy and customization are big draws.
Okay, so speed, privacy, keeping dividends, tax efficiency, maintaining market exposure. That's quite a list.
It is, and it adds up to better capital efficiency overall. Your existing blue chip assets are doing more. They're working harder by providing liquidity without being sold.
So you can leverage them for new opportunities.
Precisely. It allows for more dynamic portfolio management. You can make strategic moves, diversify, seize an opportunity without being forced to sell your best blue chip holdings, maybe at a bad time.
That flexibility sounds powerful. Can you maybe give us a couple of concrete examples? Make it real.
Sure. Let's imagine a family office. They have, say, a $100 million portfolio, mostly solid FTSE 100 blue chips. They spot a great private equity opportunity, needs $20 million. Instead of selling $20 million worth of shares, triggering CGT, potentially disrupting their core holdings, they arrange a loan for £20 million using part of their portfolio as collateral.
So they get into the private equity deal.
While keeping their FTSE portfolio intact, still getting those dividends, avoiding the immediate tax bill, that's strategic.
Yeah, I can see that. Another one?
Okay, think about an entrepreneur. Maybe she holds a lot of personal blue chip shares from a previous venture. Her current company needs £5 million for a strategic acquisition, and they're planning an IPO down the line.
Right.
She could leverage her personal blue chip shares to get that £5 million loan. It funds the acquisition. And crucially, she avoids diluting her ownership in her own company before the IPO. The loan can then be repaid from the IPO proceeds.
Using personal assets to fuel the business without giving up equity. Clever.
Exactly. Or one more, an asset manager has a client, maybe sees a really time-sensitive property deal.
Yeah.
The client has a diverse blue chip portfolio, UK stocks, US stocks.
Yeah.
Instead of rushing to sell shares, which takes time and might not get the best price, they set up a credit line secured against the share portfolio. It gives them immediate funds for the property deposit, no need to liquidate the stocks prematurely.
Those examples really clarify how it works in practice. You mentioned this is a growing area. Why now? What's pushing this into the spotlight more?
Well, a few trends are converging. For one, traditional bank lending might be getting tighter in some areas, so people are looking for alternatives. Securities-based lending against good quality blue chips looks attractive.
So a push from traditional credit tightening.
Partly. Also, there's just more acceptance and expertise now. Private banks, specialist lenders, they've gotten much better at understanding, valuing, and managing the risks associated with these types of share portfolios.
The market is maturing.
Yes, and the tools are better too. Sophisticated risk management, secure custody arrangements. It allows lenders to offer more flexible terms, better LTVs.
Makes sense. What else is driving it?
Definitely the focus on tax planning. That CGT deferral we talked about, it's a major incentive, especially for high net worth individuals looking at estate planning too.
Tax angles are always important.
Always. And linked to that is the desire for privacy and bespoke solutions we mentioned. This kind of lending offers that discretion. Finally, I think there's just a greater awareness now that these blue chip shares, which people might have just seen as long-term holds, actually represent significant accessible liquidity. They're a store of value you can tap into.
This sort of hidden value being unlocked. Okay, so it seems like a powerful strategy, but it can't be without risks or things to watch out for. What are the key considerations someone needs to really think through?
Absolutely, due diligence is crucial. First and foremost, the quality and liquidity of the specific shares you want to pledge. Lenders will look very closely.
Not all blue chips are created equal in their eyes.
Not quite. Highly liquid stocks, big names on major exchanges like the LSE or NYSE, lots of trading volume, they'll get the best terms. If you have a very concentrated position in one stock or shares that are less frequently traded, expect stricter conditions, maybe a lower LTV.
So your specific holdings matter a lot. What else?
Lender appetite. Different lenders specialize. Some prefer certain markets, certain types of shares, certain deal sizes. You need to find the right fit, someone who understands your specific situation. Working with an experienced advisor can really help here.
Finding the right partner is key. What about the practicalities, like custody?
Yes, the custody and control arrangements need to be crystal clear. Who is the custodian? Is it a reputable firm? How are dividends handled? Corporate actions? What's the process for getting the shares back when the loan is repaid? All needs to be transparent.
Transparency and trust are paramount there. And the technical risks we touched on earlier.
You absolutely must understand the margin call procedures inside out. What triggers a call? How much notice do you get? What are your options? You need a plan before you ever face one.
Proactive planning for downsides.
Essential. And understand the recourse terms: full, limited, non-recourse. Know exactly what your total exposure is. Also, keep an eye on interest rates, especially if the loan rate is variable. Factor in how rising rates could affect your costs.
Lots to monitor. Any other potential hurdles?
Yes, there can be regulatory or compliance issues if you're a company insider, maybe a politically exposed person, PEP, or have other trading restrictions on your shares. Pledging them might trigger extra scrutiny or disclosure rules.
So potential complications for some individuals.
Definitely. Getting proper legal and financial advice is non-negotiable in those cases. And fundamentally, this strategy has to make sense within your overall financial plan. It's not just about getting cash. It needs to align with your long-term goals, your risk tolerance. It's a tool, not a goal in itself.
That's a great point. It needs to fit the bigger picture.
An advisor's role is really key here, helping navigate all these points, ensuring the structure truly serves the client's best interests and leverages those blue chips wisely.
So, to sum up, it's a sophisticated approach, requires careful thought, but offers some really compelling benefits for the right investor.
Absolutely. For sophisticated investors, leveraging blue chip shares this way is a key financial strategy. It lets you keep your core investments, defer that CGT hit, keep the dividends flowing, and access capital quickly, discreetly.
Giving you flexibility and maybe a competitive edge.
Exactly. In today's market, that kind of adaptability, the ability to act on opportunities without disrupting your core strategy, can be incredibly valuable. It unlocks the potential that's sitting right there in your portfolio.
Fantastic. This has been incredibly insightful. You've really illuminated how blue chip shares-backed lending works and why it's gaining traction. Definitely food for thought.
My pleasure. It's about empowering investors to use what they already have in a smarter, more strategic way.
Thanks for listening. If this helped or made you think, hit like it shows this content matters. And tap subscribe if you haven't yet. See you next time.